Hello students, next we are going to see the illustration number 3. This also we are going to see the going to find out the comparative analysis of balance sheet. Some problems we have to identify what are the items we have to post it in equity, liabilities and then assets, and then we have to sum up and then we have to balance the equation, and then we have to proceed with the analysis of comparative statements. In this problem is kind of a problem where every detailed items are given within the category. For example, equity and liabilities, they have clearly mentioned what are all items they have mentioned given equity and liability, and what are the items available in non-current liabilities are directly given in this problem. So we are not able, we should not get into the posting the same items in different locations. It's all the items belong to the particular category are given directly in this problem. So let's see this illustration. Illustration 3 is the following are the balance sheet of Surendra Limited for the year ending 31st December 2012 and 2013. So now we have mentioned as particulars, which consists of equity and liability section. All the items belonging to equity are given within the equity and liability. They have mentioned for 2012 and 2013. Similarly, non-current liabilities also they have mentioned, and then they also the other section is asset section. So asset section items belong to non-current also they are segregated separately, and then current assets also they have segregated separately. They have also given the total of assets and the liabilities. If you check the total value of assets, it is 4,60,000 rupees and 6,80,000 rupees. It will be equal to the sum of equity and liability. The total will be 4,60,000 and 6,80,000 rupees. Really, for starting this problem, we can directly make use of the same format for our problem. It's easy just to calculate the comparative analysis, that is absolute change alone we have to calculate, and percentage of change alone calculate, because the posting values are given exactly to the same category. So we need not to rework on the posting of items within the particular category. So let's take the values together, and we can post it in our table. So equity, share capital, non-current liabilities, assets, everything we have mentioned here. Then we have to calculate the absolute change. Absolute change is calculated using a formula. The current year value minus previous year value. The current year value is 3,30,000 minus 2 lakh, the equity share capital value. So in this way we have to calculate the all absolute changes of all the items. Items without carrying any values or return zeros, it should be taken away. Next we have to calculate the percentage of change. Percentage of change is calculated with the formula. One is absolute change divided by previous year value, that is 2012 value, into 100 percentage. So percentage of change we have calculated here. Similarly, we have to calculate the percentage of change for all the values given in the balance sheet. Remove those values of the cell which does not contain any value. The direct formula application. So absolute change is current year value minus previous year value. Absolute change can be either a positive value or negative value. Based on the change of each item, we could able to understand how the company is performing, how the amount has been increased. If there is any justification, they will be given in the notes column also. So first we have to calculate the absolute change and followed by the percentage of change. Once we done this, then we have to find out the interpretation of data based on this analysis. So first we taking into account of equity and liability. The equity share capital has been increased by 65%. There is a 1,30,000 has increased. In this case, it indicates that the company has raised more money by selling shares. Next is preference share capital. So preference share capital is also the mode of money which has been generated from the preference shareholders that also have increased by 50,000. There is a 50% increase on that. Next is reserves. Company have grown the resource. Example, they are maintained for some any kind of emergency or any profit which can be kept for using to for later use is called as reserves. Now the reserves have increased by 50%. Next is profit and loss account also have increased by 33.3%. That is 5,000. Company has made more profit compared to the previous year. Next is profit and loss account is also increased. Next is bank overdraft stayed the same while creditors' money owed to the supplier has been increased by 10,000 rupees. There is a 25% increase in credit. Similarly, if we compare all the equities and liabilities together, there is an increase of 47.83%. There is a growth in funds and obligations. Funds are generated through equity share capital and then the preference share capital. Next, we have to see on the asset side. We find the fixed assets. It has been increased by 45.83%. That is 1,10,000 rupees, indicating that the company has invested in long-term assets. Next, the stock and debtors. This grew by 20%, 25%. That is 10,000 rupees and 25,000 rupees, 25%, meaning that the company has more inventory and customers are buying on credit. Next is bills receivable. Bills receivable is the amount which we have to collect from the vendor. That has been increased by 200%, showing that the company expects more payment in the future and we have to collect from the vendors. Next is cash in hand and cash at bank has been increased significantly, indicating there is a better cash flow and liquidity. If we see the overall total assets, there is a growth in assets by 2,20,000 rupees. There is almost 47.83% increase in the assets. This mainly due to the amount generated through the preferential share and then the equity and share capital. So let's summarize what are the basic items we could derive from this analysis. The company has raised more money by issuing shares and kept more profit, but also owes more to suppliers and has higher tax obligations. On the asset side, it has invested in new fixed assets and is holding more cash, while also expecting more payments from the customers. Overall, the company is growing and appears to be stronger financial position compared to the previous year. Hence, this company can be considered for the investment based on our comparative analysis of financial statement. Thank you. We will see you in next class with new problem.